I'm Matthew Galgani with your IBD 2-minute tip, what to do after a follow-through day. The stock market is always in one of three stages: confirmed uptrend, uptrend under pressure, or market in correction. You can see which one the market is in right now by checking the market pulse graphic in the big picture column each day. When we're in a correction, how can you tell when the market has rebounded and a new uptrend has begun? By looking for a follow-through day. Put simply, that's when the market decline is bottoming out and you have a big gain in one of the major indexes on volume heavier than the day before. That helps confirm that a new uptrend has begun. For a full explanation of the follow-through day concept, see the education section of investors.com. Since 1880, no sustained market rally has ever started without a follow-through. However, not all follow-through days work. Historically, about 1/3 fail, and the market quickly falls back into a correction. And that's why it's important to know what to do after a follow-through day occurs. Here are 3 basic rules. First, get back in gradually. A follow-through day is like when you're in your car and the light turns from red to green. You don't just blindly shoot through the intersection. You look to see if anyone's running a red light, then you move forward. It's the same with the market. Make sure the coast is clear by buying a position in 1 or 2 stocks, and not just any old stock. Make sure it has solid fundamentals and is breaking out of a sound chart pattern. If your stocks perform well and the new market uptrend shows strength, then you can begin to move in more aggressively. If they don't, then you put on the brakes and get back out, without having put too much of your money at risk. The second thing to do after a follow-through is watch for distribution days, or days of heavy selling in the major indexes. If you see distribution days right after a follow-through, that can spell doom for the new uptrend. In fact, research shows a distribution day on the first or second day after a follow-through will kill the new uptrend 95% of the time. Finally, when a follow-through day occurs, make sure you know what stage of the current bull cycle we're in. A bull market can last 2 to 3 years or more, but along the way, you'll have interim corrections where the market declines for a while, then resumes its climb by logging a follow-through day. So you'll want to ask, is it a brand new bull market coming off a long downturn? That's what we saw when we had a follow-through day in March 2009, following the financial crisis. Or is it a new rally coming in the later stages of a long-running bull cycle? That was the case on May 31st, when we had a failed follow-through day. At that point, the bull market was already over 2 years old, and history shows you'll have more volatility in those later stages, as the market and leading stocks may be running out of steam. As a general rule, there's more room for stocks to move higher in the earlier stages of a bull market, so you can be more aggressive. But you want to be more cautious after a follow-through day that occurs in the later stages of a bull run. Stick to these rules after any follow-through day and you'll minimize your risk while still setting yourself up for good gains if the new uptrend takes hold. That's your IBD 2-minute tip. Thanks for watching.